Our investors kindly told me, like, this is probably not going to make it. We built DocSend for the end user, not the economic buyer. So we'd like lose these 100K plus deals because the competitor would have more dashboards for the CMO or the CRO, and the salespeople would prefer DocSend, but the person buying it, if it had more features for them, they'd go buy the alternative. I ran around being like, does anyone want to buy this company? And everyone was like, no, not even for $1, which is generally what happens for startups. Dropbox looked at it and they're like, sure, this seems really good. And so they offered us $165 million. And then our investors were like, oh, we didn't think you were worth anything. Everyone made money out of this. I actually did the math and we beat the IRR of every fund that was an investor in DocSend. That made me proud. Even though $165 million is not like the venture return you're looking for, where you're trying to return your fund, we still did very well for everyone involved.
Welcome to the latest episode of High Stakes. I'm Paige Soya, Managing Director and Partner of K Street Capital. And today's episode, we have a very special guest, if not a celebrity in the venture capital world, from my perspective at least, the CEO and founder and creator really of DocSend, a tool that all of us use, every single day, multiple times a day. But before we dig into this is Russ Heddleston, and do you want to go ahead and give your quick background, and then we can start talking a little bit about some of your exits.
Sure, sounds great. So as you mentioned, most recently I was the founder and CEO at DocSend. I had two co-founders, Dave and Tony. We all went to undergrad together at Stanford. So my background is Stanford undergrad and grad in computer science. Worked at Microsoft one summer, decided I didn't want to build version 8 of the toolbar, and have been doing startups since then. Worked at mobile ad tech company out of Stanford, which was very interesting, learned a lot. I went back to business school at Harvard, started my first company there, which we raised a little bit of money for. We got a product out. We were going to pivot because it was going to fail. We sold that to Meta as a talent acquisition. And then I was a product manager there working on the Pages products, and then left Meta, got to see them go public, which was fun. Started DocSend in 2013. Ran that for 8 years, and then we sold it to Dropbox in 2021. And then, I have since left and started anew.
Yeah, actually, I know we're really mostly going to focus on the exit story here, but maybe do you want to share quickly the new thing that you're working on?
Sure. It's called Distill. It's not stealth. It's just we're working on something pretty straightforward to begin with, which is just AI profiles of people and companies. It's like what you'd get if you spent 15 minutes searching around the internet for a person or a company, combined into a nice, easy report. Kind of like Wikipedia for everyone else is one way of thinking about it. So, or if search existed just for people and companies, it wouldn't be a bunch of listings. It would be some integrated kind of summary of the information. So we have citations, which is really cool. We cite all of our sources. And so you can kind of see everything we found about the person, everything we extracted, and then it all gets kind of built up into this little Wikipedia page. So we're working on that problem, which has been a lot of fun.
Such a cool problem to solve, and a really big one that I think everybody has. And thank you for letting me be a beta user. I've really been enjoying seeing the product evolve even to where it is right now. So very excited for what that ends up being ultimately.
Awesome. Yeah, if DocSend was basically trying to get people to not send attachments everywhere, this still would be trying to save people from Googling for people and companies, because that has always struck me as very inefficient.
I mean, it will save so much time to have that all in one place, and it's already doing it. So it'll just be really cool to see how it evolves and combines more information over time. But I'm going to go ahead and pull up this one slide. I mean, I think everybody knows that this was back in 2021 exit. So maybe just a quick backstory on the Dropbox exit, and then we can dig in on a couple of the interesting takeaways.
Yeah, sure. DocSend is just a great story. It's, in 8 years, we always joked that if we made it, it would look super easy. In retrospect, we'd be like, oh, some companies just are lucky, and because we had to slog it out, and we did 2 pivots in the middle. But when you zoom out far enough, it's this perfect hockey stick of revenue growth. We started in 2013. Dave, Tony, and I, as I said, Dave, Tony, and I all went to undergrad at Stanford together. We all worked at this other mobile ad network called Graystripe together. And then, we wanted to just work together to build a company. It's not as romantic as I had this problem since the age of 4, and I've always had to, my life's goal is to fix this problem. Dave, Tony, and I are like, build a company because we think we'd be pretty good at that. And we wanted to build a product that we can be proud of, that works well. We all had this design school thinking from Stanford in our heads. And so we had to fiddle around for a while finding a problem that we thought was worth solving. And then we landed on this attachment problem. So we started that in 2013. Over the course of those 8 years, we raised a little under 15 million. We raised 1.7 million in a seed round. We then raised 8 million in a Series A. It was like preempted. We didn't really have enough revenue to justify the Series A. We then went up market, tried to sell like to sales enablement after starting, kind of self-serve, almost ran out of money, had to pivot again back to self-serve again, where didn't change the product. We just changed the pricing, packaging, positioning. That worked really well. And then raised 5 million from DCM, which was not a down round. It was just, we had better offers. It's just, we were aligned with them on kind of what we wanted to do with the business. And so we raised 5 at a 50 million post, and we were about 5 million in ARR. And then within a, few years after that, we sold to Dropbox for 165 million in cash in March of 2020.
Thanks for sharing that backstory a little bit too, because I think DocSend is like an incredible product with an incredible story and a great exit. But I think that it took a long time to get there, not a long time, but the amount of time you would expect. And I think the ups and downs of that, it's just like incredible that there were, I think points in that journey where you had to completely pivot to change everything, raise capital at different stages when you may not have wanted to, and gotten through it and actually built something that really did solve a problem and has a positive story with it. So that's super cool.
Yeah, I'm so proud of it. It's a great product. Like, I still pay for it. It's great. Like, it was original product I wanted to exist, and it's still a product I love. And yeah, I think I had one person interviewing at DocSend years ago ask me, like, kind of conspiratorially, do you guys actually use your own product? It's okay if you don't. I'm just kind of curious if you actually use your own product. Like, yeah, I use it every day. And they're like, it's okay to say that you don't use it. I'm like, no, like, who's not using their own product? And they're like, oh, most companies. And I was like, that's so weird. So yeah, I'm very proud of what we built with DocSend. It's great. I still don't have a great alternative to it. It serves a niche. It's a great utility, and it definitely replaces the need for me to send attachments out.
Absolutely. And it's still highly used today. So I think it will be for a long time. So maybe talk a little bit about I guess this was 2021 when the exit happened. And I mean, I think everybody knows it was like an insane time, but maybe just talk about that time period, the market environment, and, during when you ended up exiting.
Sure. And as context, in 2018 was when we were running out of money, and the upmarket sales enablement strategy wasn't going super well for us. It was going okay, but it was expensive. The contract values were smaller. We built DocSend for the end user, not the economic buyer. So we'd like lose these 100K plus deals because the competitor would have more dashboards for the CMO or the CRO, and the salespeople would prefer DocSend, but the person buying it, if it had more features for them, they'd go buy the alternative. And so we'd like win the evaluation, then we'd lose the deal. So anyway, we did that for a few years before I figured out how sales works. Like, I, got this kind of crash course in sales. So in 2018, our investors kindly told me, like, this is probably not going to make it. Maybe go, you tried your best, return the money, walk away, back on the next one. And we're like, no, there's something here. And we're at 4 million in ARR. So we then kind of did what I mentioned around like changing some things up, and it started to work better. So you have to have that as context for when we sold, because what happened was in 2018, I ran around being like, does anyone want to buy this company? And everyone was like, no, not even for $1, which is generally what happens for startups. If you try to sell your company, no one wants to buy it, even if you've got 4 million in ARR. And so that was good to know. And so we went back to building our work. It was great. You're like, we just have to build a business. And then I got an inbound offer from another public company wanting to buy us. CEO I talked to before was like, Russ, I actually want to buy you now. My board says I need to do something different. And I think you have a great value prop, but we were more expensive. I had interned at Dropbox while I was at business school. In 2010, I tracked down Drew and said, I love your product. Let me come work for you for the summer, when there were like 20 people or something. And so
cool.
Dropbox looked at it and they're like, sure, this thing's really good. And so they offered us 165 million. And then our investors were like, oh, we didn't think you were worth anything. This is very good. And so that it was the context for our offer, which then we sold, because that discussion started in like January basically, and we sold in March. It was pretty fast. And then later in 2021 was when things got pretty crazy. So we happened like right before that summer when things got really nuts. But also at the time, the product-led growth companies still weren't like all that hot, I guess. So I learned so much that, I would do differently next time with a similar company. But we did have like offers to raise money at, 2x the valuation that we were selling for. But this is a interesting, almost philosophical conversation around, as founders, you've been at it for 8 years. If your investors want you to cash out, depending on like who wants liquidity? Is it worth doing now, or is it kind of worth going on? Because we were 15 million in ARR at the time. Dropbox are proud of their acquisition, so they mentioned the kind of numbers there. We were profitable, and but 15 million in ARR is still a long ways from like a going public level, right? It's like a good business, but you're a long road from like being a public company. So, there's we can get into it if
Yeah,
you
and you
want,
were
but yeah,
already, already
on
eight
both
years
sides
in.
of the thing here. So I'd say, in many ways, we hadn't raised that much money. Everyone made money out of this. I actually did the math, and we beat the IRR of every fund that was an investor in DocSend. So that
Oh,
made me
yes, you
proud.
did.
Even though,
Yeah.
165 million is not like the venture return you're looking for, where you're trying to return your fund, like have one investment return the fund. We didn't return anyone's fund at 165 million, but we still did very well for everyone involved.
It's a really good story. And I mean, I guess at that time, I'm just thinking 2021. So it was you sold for an 11x ARR, and you mentioned you had other offers that were higher priced offers, but you ended up choosing Dropbox, and I understand completely the timing of that making so much sense. But I wonder maybe if you can share a little bit about why you decided that Dropbox was the right fit.
We didn't shop it around, and I guess I'm conflicted about that. The summer before, when we crossed 10 million in ARR, our board, like our investors, were like, "Oh, people probably don't know that you're doing well now. People probably think you're dying, but you're actually doing quite well in the range of all the companies we see. So maybe get a banker to coach you, not to like run the process, but just to coach you." So I had like a banker coach type of person. It just happened to coincide with kind of getting this offer. But the banker coach, I got this offer, and I was like, "Oh, hey." He's like, "Oh, neat." I went to Dropbox and another one. I was like, "Oh." And then I asked the banker coach, and he was like, "Well, I'll be your banker." So it went from coach to actual banker. And then he was like, "You don't have enough time to run a process." And I was like, "Well, okay." So I think in retrospect, I probably would have gone around and ran a process, but I can see his logic, where if you get another company to rush into the process, then you might not be able to trust their term sheet. That term sheet might fall apart. I think in retrospect, things I didn't weight highly enough is like that we were profitable. So, most companies, if you're like running out of money and trying to sell, that timing can be really critical. Like if you don't sell, then you need to raise more money, or you're like out of runway and you're like, it's existential. But for us, we're like, we're fine. So anyway, we chose not to shop it around, and we just went with Dropbox. The fit with them is pretty clear, just because they're a product-led growth company. They had zero acquisition cost. The mechanisms that Dropbox used to grow are different than for DocSend, but they're very similar in that they're like all inbound, self-serve. The ACV for DocSend is bigger than for Dropbox, but there are just a lot of similarities there. And Drew, to his credit, he looked at DocSend and like just told his team, like, he's like, "Yeah, just buy that. This is the obvious fit for us." So I think they had some familiarity with like how DocSend was growing, and that it was like a great product people liked, so it probably would keep growing.
And I forgot that you were like long before DocSend an intern at Dropbox and knew Drew way before this even happened. Do you think that played a part? Or maybe I guess like in a way it played a part because they knew about you, they knew DocSend, and they knew what it was, so they could come to you directly and make that offer. But just curious if that relationship you think played a part in the end deal.
No, I don't know Drew very well, but like as a semi-known quantity to him, I think it helped get in the door, I guess. But no one spends 165 million on like someone just from a buddy. Really, actually,
Right.
sometimes I've seen that happen. Like that does happen. This was not that case. Like this was like looking at our financials, they were like, anyone would buy this company at this amount. Like one of our lawyers, the M&A lawyer, he was like, one point he's like, "They're getting it so cheap," and I was like, okay,
Yeah.
so I think the cleanliness of our revenue, because our metrics were pretty buttoned up. So a lot of times startups have a lot of skeletons in the closet, whether that's employment contracts or these like weird enterprise contracts where you have to dig through them, and then they're like change of control provisions maybe that get triggered. This is all, mostly self-serve revenue, all on like the same self-serve contract. And it was just really easy to like just look at the Stripe logs for this revenue and the customer base and be like, "Yep, this is exactly what it says it is." Like we were 65 people, so it's like, "Yep, here are all the employment contracts. Like this is everything." It's like it just kind of is like what it looks like it is. And most startups aren't that squeaky clean, and we were. So I do think like knowing Dropbox, like it's a reason they responded to me. I think if another company had just sent them a random email, they wouldn't have gotten back to them. But that's not the reason I think that they felt comfortable like making the
They
acquisition.
made the decision. Yeah, exactly. Yeah. And the other thing too is like timing is everything. I think you, in hindsight, like you would never know. I mean, it was March of 2021. If this had happened, if you'd said, no, let's run a process, and then you got to like mid 2022 with a term sheet that ended up not being a good one, and then the multiples completely changed and the whole market locked up. And then, like, who knows? I mean, you didn't have to sell because you were profitable,
Totally.
but
Oh my God, the roller
yeah, it
coaster
could
is
have.
huge, which I think a lot of people lose sight of or forget or their memory is short type of thing. But someone that summer told me, they're like, if you'd stayed independent, you'd be worth like well over $1 billion. And I think that's probably true as like on paper though, but then it's like, okay, like longer term, like what's the metric you're going for here? Like if you want to be a public
Mhm.
company. And so our thinking at the time was like, yeah, we're kind of selling at like the then SaaS multiple, public SaaS multiple, which since the market has come down again, that's come in half from what it was. So if you were going to sell for the public SaaS multiple, it'd be different now. So yeah, there's just like a lot of factors to consider in this. And I will say that as a private company, there's a discount for selling the business. It's interesting because as a public company, there's a premium for change of control to take the company private. You got to pay more. But as a private company, I think it's because of the skeletons in the closet type of thing. You
Mhm.
usually, if you're going to sell your business, sell for significantly less than the valuation you'd get if you were raising more capital.
Exactly. Yeah. And I do think it's the skeletons in the closet thing, like being buttoned up and having a sale happen in like less than 2 months is very unusual. Even if it was a simple, to your point, like seemingly simple business model, we've seen tons and tons of SaaS ARR type business models that their financials were in a complete disaster state. And I think if they had gone to sell, it just would have been a mess. So anyway, props to you for doing that and your accounting team.
Yeah, at some point they
Uh,
were asking a lot more questions, and I basically just politely said, like, do you have everything you need? If you'd like to walk
Either
away,
buy
that's
it or
okay.
don't. Yeah.
Yeah, because we were
Yeah.
profitable. Like I was kind of like, okay, I felt like I was doing my fiduciary obligation, is what I felt like.
Yep.
Because it was for, who are the people at the table who own equity in this business? What are their preferences? Like, and so having gone and talked to everyone involved, it felt like a reasonable decision to make and the kind of risk adjusted one to make on behalf of the team. But it was hard for me because it's like, oh, we could have raised it a much higher valuation. And so yeah, and doing the kind of diligence, saying like it's okay, you can walk away. They came back and said, nope, it's great, done. And so they
Just do it.
happened very
Yeah.
fast. Because they did have all the information they needed. I think if you're in a role of like trying to being the one who's responsible for doing an acquisition, you're pretty paranoid as an employee of the company. So those people
Mhm.
always want to ask more questions, but at a certain point, diminishing returns to asking more questions or digging into details more. Like a lot of that stuff is like post-acquisition stuff you want to do, So anyway, it's interesting
Yeah.
how it
Totally
unfolded, but it
agree.
happened pretty quick.
Well, and maybe share a little bit about what went better than you expected in the transaction or afterwards, and what went worse or didn't go as you might have expected.
It was pretty easy to get to close, so that part was pretty smooth sailing. We kind of had all of our ducks in a row. It was still a lot going through diligence for M&A, but that part wasn't as bad as I thought it would be. And then we did the deal in all cash. Dropbox, I think, probably still has a lot more cash on hand, and so that was like preferable for them than equity. And so that's a big major decision point for founders, cash or equity. We only had the option of cash, so there's no choice there. But their stock value was I think largely flat. I keep a close eye on that, but over the last few years, I don't know. It's varied a fair amount, but it's not like up 3x or something like that. So doing the cash part was fine, especially if it's a public company. It's kind of equivalent cash or equity because you could just sell the equity to get cash. Our
True.
performance post acquisition did better than I thought it would. I think in that regard, hindsight's 2020. But if I knew that we were growing a lot and that it was going to continue to go well, I think I didn't appreciate exactly how well it was going to go for us. On the could have gone better side, there's a big list of learnings there I've got, which some of it's idiosyncratic, just specific to this situation with Dropbox as an acquirer, with the type of business that DocSend was. But I generally sum it up as like, as the CEO, my role was I was really looking out for everyone else, but I didn't spend as much time thinking about my own role. And I think that is something I would do more of next time. Like, what am I going to do at this company? Because it was a long holdback period and it was unclear. And I would have put more structure around that. Or I think, I would have negotiated harder or just asked to not go along with the deal. Because I do think when it's a tech acquisition or a talent acquisition, like you're paying for the team, when it's like a company acquisition, there's some amount of like, you want to keep the founders on board a little bit, but not as long as they had it as. And I think generally I just would have put more thought into pushing them on integration plan, pushing them on commitments, and then figuring out my own role and what that would be like post acquisition.
Yeah, that makes a ton of sense. And I guess, would you say you were happy overall with the outcome?
And with startups, it's so funny. Like it depends on the metric, the baseline that you use. I still think we left a lot
It
of money on
does.
the table
Everything
by
is
selling.
relevant.
Yeah, by selling what we did. I mean, we could have always sold as private equity. We could have cash flowed the business. I think it was reasonable to do at the time. I'm very thankful that DocSend did well overall if I zoom out, especially relative to a few years before in 2018 when we were not doing well selling at marketing and sales enablement. So I'm super thankful like that worked out. Yeah, on the whole, I feel very thankful and frankly lucky. Like we did work hard. We did figure out some stuff. Like we kept going when we probably shouldn't have kept going and figured out some things. But yeah, there's definitely an element of luck in it, and I feel very fortunate. Also, it's the team. Like we had a great team of people, like having two co-founders who I've known for a long time. Like we're all still friends. We all still catch up regularly. That's really unique. It's not unique, but it's pretty
Definitely.
rare because a lot of times founding relationships are pretty rocky just because of the stress that you're under with these people and the fact that we got through all this and like still, have a ton of respect for each other and are good friends, like is pretty wonderful. So yeah, on the experience overall, yeah, I feel very fortunate.
That's awesome. And were they sort of in the same holdback period as you? Like, were you guys together for 3 years after the transaction?
Yeah, they modified it a little bit, but by and large, yeah, it would
Yeah.
have been 3 years in March, and because of how well it was going, they were okay with me taking off and being an advisor a little bit earlier and let me get going on whatever I wanted to do next. So that was very nice of them. But yeah, we kind of like scattered a little bit afterwards. They had some structure that they put in place in terms of breaking up DocSend across the groups. But yeah, it was 3 years, got short a little bit, and then I left, did a little traveling while I was an advisor, and then got started on my current project at the beginning of this year officially.
Very cool. Well, I know we're coming up on time, so I'm just going to stick to two last questions that I love to ask, and I think especially with DocSend, these might be interesting because you kind of talked a little bit in the beginning about how you started the company and it's sort of a different way of going about starting a company maybe than other people have been dreaming of doing, solving some specific problems since they were 4 years old. But the question is, did you build the company with the exit in mind? And if you did, like what illusions did you sort of have about the company or where the value was in the business versus like the perceived value versus like what actually was valuable about it in the end?
We didn't build DocSend with getting acquired in mind, which is kind of funny. We just wanted the experience of building a product together and a business together. And we just kind of assumed that if we created something of value, like good things would happen. But I got that question throughout the entire history of the company. What's your exit strategy? What's your goal with this? And it doesn't feel good to say like public company or bust because that just seems like kind of extreme. Although I think it's a valid answer to say public company or bust. But like that wasn't, I don't know what you do to go about being public company or bust. Like I think the immediate actions that you're taking around, like just make a product that people like, then make a business that's working, keep an eye on margins, like all this incremental stuff that you're doing along the way. So we didn't have an exit in mind. We just wanted to create a product that we were proud of and like a great business, frankly. And then, yeah, it was fun to follow that thread through the history of the company. And what was the other half of the question?
Just like if you had any illusions about where the actual value was in the product or what was the reason you ended up getting bought?
I found that to be surprising and heartening that the original seed pitch deck we had for DocSend was what worked in the end. We just had this 3 years in the middle where we tried to go up market and sell it to sales enablement, which was okay, but I learned a lot about sales and I also learned that you can't really have multiple go-to-market strategies. And so going back to like what ended up working for us, I think we probably should just stuck with that from the get-go. So that was, I think, surprising to me that it worked as clearly as we thought it would at the beginning. And then also it just like worked so well. It just took a long time, but it worked phenomenally well. Like we were like before we sold, like Tony, our CTO and the co-founder would just like in front of the company be like, this is crazy, people. This is crazy. We're not doing anything. It's just growing and people are just paying us money. So we were actively profitable because we didn't need salespeople. We didn't need, humans to sell the product. The product is just growing on its own organically. We're not paying for demand gen or anything. And we were profitable accidentally because we didn't want to hire engineers that fast. Like we wanted to be thoughtful. And so, like revenue is growing faster than like we wanted to grow headcount type of thing. So that
Exactly.
was really cool to see when that worked. And it was also really gratifying to see even post-acquisition, like it just continued to work. So
Yep.
yeah.
Yeah, I'm sure that simplicity really plays a role in that. But then, like, you get caught up in all these ideas and things that you could do to the product to make it better, make it sell more, and I think that sometimes like taking you in the wrong direction versus like the simplest solution oftentimes is the best one. And in this case, I think
Sometimes I think the other thing that I have, well, one of the many things I have as a takeaway from DocSend is that simplicity is a defensible advantage. We had numerous big companies say, we're going to kill you. We had a number of acquisition offers along the way with DocSend, some of them not very friendly. And we had multiple companies try to copy us. And no one ever really dented any of the DocSend growth because DocSend is just like a pretty straightforward product that does what it says it's going to do. And if you tuck the value prop away in some other system, it really makes it hard to find. And so the simplicity of DocSend is itself a defensible advantage. And so it's amazing that without any traditional moats, DocSend has done as well as it's done. And it's like still is like continues to be more pervasive, which is wild, given that, it's a
it's
tool
pretty
that's
incredible.
copyable and anyone could have done this. And, like that. It also is worth
Wow.
noting that DocSend is a relatively complicated product to build in terms of like the document processing. It's not like a weekend project or something. It looks simple, but a lot of that was a lot of hard work to make what is not a super easy product to build look really easy to use.
I'm sure that's super cool. So I guess last question, and then we'll let you go. But this is incredible. So thank you for taking the time to go through this. I think it's a really great story. And you did give some advice along the way. So maybe this is a moot question, but is there any advice or anything else you'd want to share with others who are considering an exit?
I think what I did was the right thing to do around asking for a lot of opinions. Like just go ask for advice from people, figure out what category of company you are. I do think it's worth having a walkaway number. I've heard a lot of stories of people who get an acquisition offer and they're like, no, we're going to go big. And then they keep going and then that goes away and then it's worth a lot less later or goes to zero. And so that was one school of thought that motivated us to sell as well, which is like, what if we work on this for another 5 years and it's the same like exit value? Or, what if Dropbox competes with us? Or what if it goes to zero later? At a certain point, when you calculate your own equity value in the business, what that's worth, like, can you really afford to keep gambling that effectively? And so, yeah, I think for any founder that's considering an exit, trying to make sure you're not drinking too much of your own Kool-Aid. I guess go get a variety of opinions. I'd also say just remember that a fair deal is one where both sides are a little unhappy with it. And that having talked to a lot of founders about their acquisition stories, most people aren't super thrilled with them. Some people are, they got real lucky and they're like, thank God we sold the company. But a lot of times, especially if it's like a good business, yeah, so they're going to be rough here. They're celebrated, but generally behind closed doors, there's a lot of frustration with them. So if you're a founder, just keep that in mind as you are thinking through like sell or don't sell or keep going or what your options are.
Yeah, I mean, it's true. Like, it's like when you sell your company, it's almost like you're getting married to the buyer for at least some amount of time. And that marriage is hard and it's never perfect. And there's always things about it that aren't exactly what you would expect or want. I think that's okay. Like, that's just life. There are plenty of great marriages that suffer through that. All of them do, really, I think. So it's a really cool story. And I appreciate you sharing this. And I think this is great advice for everybody, not just like the founders, but also investors out there that when they're thinking about, or board members when they're thinking about approving or giving advice about if they think the company should sell or not. This is like a really good story of the right timing, and also just an incredible product that I just have to say thank you for building it. We use it every day, honestly. Like, it has changed our world and many, many other people's. So
That's awesome.
thanks.
Well, thanks. I've described the entrepreneurship journey to one person as coming up with an idea where you say, I think it's a great idea. And then everyone else says, we think it's not a good idea. And you say, no, I think it's a really good idea. And then you go and build it and then it becomes a great idea. And everyone's like, oh, wow, ta-da. And so, yeah, it's wonderful that people use the product. It makes me very happy. And it was a wild ride and a lot of fun.
Well, congratulations on everything and excited to see the new product. And I'm sure the whole world will be too very soon. And that's a wrap. So thank you.